There are fortunes being built right now, in places most people aren't even looking, while the crowd chases the familiar, the obvious, the comfortable. There are entire economies transforming, entire populations rising into prosperity, entire industries being born that will define the next 3 decades of wealth creation. And the question isn't whether these opportunities exist. The question is whether you have the vision to see them and the courage to act on what you see. Let me tell you something that's going to sound controversial, but I need you to hear it. The greatest investment opportunities of the next decade aren't in Silicon Valley. They're not in Manhattan. They're not in the places where everyone's already looking. Emerging and developing economies are forecast to grow 2% in 2025, while advanced economies are expected to grow just 6%. That's not a small difference. That's not margin of error. That's a chasm, a gulf, a fundamental divergence that separates those who will build wealth in the coming years from those who will watch it being built. And here's what fascinates me. Here's what keeps me thinking late into the night. The collective output of emerging markets now accounts for 56% of global GDP in 2025, more than half. Let that settle into your consciousness for a moment. More than half of everything being produced, everything being created, everything being valued in the entire world economy is happening outside the developed markets that most investors obsess over. But that's not even the most interesting part. Emerging markets have been responsible for 5% of global GDP growth in the past 10 years, 2/3, while developed markets were growing incrementally. Emerging markets were transforming, and most investors, most people, they missed it entirely. Now I want to take you back to a memory that shaped how I see the world. This was many years ago. I was young, still learning, still making expensive mistakes. I met a man at a conference, successful businessman, made his fortune in traditional American industries, good man, smart man. He pulled me aside and said, I keep hearing about these emerging markets, China, India, Brazil, but it's too risky, too volatile, too uncertain. I'm staying with what I know, American blue chip, safe, stable, proven. And I understood his fear, I truly did, because fear is a powerful force. Fear keeps us safe. Fear protects us from danger. But fear also keeps us poor. I watched that man over the years, watched his portfolio grow steadily, safely, predictably. And I watched the opportunities in emerging markets multiply, not smoothly, not without volatility, but multiply nonetheless. And by the time he finally felt safe enough to invest internationally, the best opportunities had already been captured by those willing to act when things felt uncertain. That's the lesson. Not that you should be reckless. Not that you should throw money at anything foreign and hope for the best, but that the greatest wealth is built by those who can see value where others see only risk, who can recognize transformation while it's still uncomfortable to acknowledge. Let me give you some context that might surprise you. According to RBC Global Asset Management, emerging market stocks are priced at roughly a 35% discount to developed market equities on forward price to earnings metrics, the largest discount in the last 15 years. Think about what that means. These are companies in the fastest growing economies in the world. Companies serving billions of consumers entering the middle class for the first time. Companies at the forefront of digital transformation, infrastructure development, technological innovation. And they're trading at a 35% discount to companies in slower, growing, more mature markets. Why? Because people are afraid. Because people don't understand. Because people would rather pay a premium for familiarity than get a discount for opportunity. And that is exactly where wealth is created. Now, let me be very clear about something. I'm not telling you to blindly invest in emerging markets. I'm not suggesting you throw caution to the wind and bet your future on volatility and uncertainty. What I'm suggesting is far more profound than that. I'm suggesting that you need to fundamentally rethink how you evaluate opportunity. Because the world has changed, is changing. Will continue to change in ways that make yesterday's investment strategies obsolete. Emerging markets and non-developed countries account for roughly half of global GDP, as well as nearly 90% of the world's population. 90%. 9 out of every 10 people on this planet live in markets that most Western investors consider too risky to seriously explore. Can you see the absurdity in that? Can you see the opportunity? Let me tell you about India, because India is a perfect case study in how most people think versus how wealth builders think. India's GDP per capita is currently similar to the level at which China's growth inflected upward. Do you understand what that means? It means India is where China was when Chinese growth exploded, when Chinese companies became global powerhouses, when early investors made fortunes that changed their families' destinies for generations. But here's what most people hear when you tell them that. They hear risk. They hear volatility. They hear unfamiliar systems, different regulations, cultural barriers, political uncertainty. They hear all the reasons to stay away. And while they're hearing all those reasons, India is planning investments of $4 trillion in infrastructure by 2025, roads, railways, ports, digital infrastructure. The entire foundation of a modern economy being built at a scale that's almost incomprehensible. I want you to think about something for a moment. When America was building its interstate highway system in the 1950s, when we were electrifying rural areas in the 1930s, when we were laying railroad tracks across the continent in the 1800s, those weren't safe, comfortable investments. They were bold, uncertain, controversial projects that many people opposed and few understood. But the people who recognized what was happening, the people who understood that infrastructure creates the foundation for decades of economic growth, those people built wealth that lasted for generations. That's what's happening in India right now. India is laying down roads at a blistering pace, with an average of 8 kilometers of highway per day being constructed, forming one of the world's largest road networks. Every single day, roads that will carry commerce, enable trade, connect producers to consumers, link rural areas to urban centers. And it's not just physical infrastructure. Investment commitments in India's data center industry are expected to exceed $100 billion by 2027. The digital backbone that will support the next generation of economic activity, the foundation for fintech, e-commerce, digital payments, artificial intelligence, all the technologies that will define the 21st century economy. But here's what most investors don't understand. Infrastructure isn't just about the physical assets being built. Infrastructure creates ecosystems. It enables transformation. It multiplies opportunity. When you build a highway, you're not just creating a road. You're enabling factories that weren't economically viable before. You're connecting farmers to markets they couldn't reach before. You're reducing transportation costs, improving logistics efficiency, enabling just-in-time manufacturing. You're creating a cascade of economic activity that generates returns far beyond the initial investment. That's what India has been doing through recent initiatives, including improving intercity travel, streamlining bureaucracy, improving physical infrastructure, and developing cutting-edge digital infrastructure. They're not just building things. They're creating the foundation for decades of economic growth. And most investors, they're watching, waiting, trying to figure out when it will be safe to invest, missing the entire point. By the time it feels safe, the extraordinary returns will have already been captured. Let me tell you about a woman I knew, called her mentor for years. She had a gift for seeing patterns others missed, and in the early 2000s, she said something that everyone thought was crazy. She said, the next 20 years belong to Asia, not as a theory, as a certainty. The demographics are clear. The infrastructure investments are massive. The trajectory is set. The only question is whether Western investors will recognize it in time to profit from it. People laughed. Not to her face, but behind her back. Asia was still seen as a manufacturing hub, a place to outsource, not a place to invest seriously. She didn't care. She studied. She researched. She traveled. She met with companies, government officials, entrepreneurs. She learned the landscape, and she invested, not recklessly, carefully, strategically, but boldly. 20 years later, she's wealthier than most people can imagine, not because she got lucky, because she saw what was happening before it became obvious, because she was willing to act when others were afraid. That's the game. That's always been the game. Recognize transformation early. Position accordingly. Have the patience to let it unfold. Have the courage to stay invested when everyone else is panicking. Now, let me talk about something that makes most investors uncomfortable: currency dynamics. The US dollar is likely to stay on the back foot relative to emerging markets' currencies amid a softening US labor market and a potential increase in investment flows into emerging market stocks and bonds. Most American investors don't think about currency. They invest in dollars. They think in dollars. They assume the dollar's dominance is permanent and unchanging. But currency relationships aren't static. They shift. They evolve, and those shifts create or destroy wealth in ways most people never see until it's too late. When emerging market currencies appreciate against the dollar, you get a double benefit as a foreign investor. You get the appreciation of the underlying assets, and you get the currency gain when you convert back to dollars. That's compound growth on compound growth. But it's more than just currency arbitrage. A weakening dollar can boost flows into emerging market stocks as investors look for higher returns outside the U.S. It creates a virtuous cycle. Dollar weakness leads to emerging market strength. Emerging market strength attracts more capital. More capital leads to more growth. More growth leads to further currency appreciation. Understanding these dynamics, really understanding them, that's what separates sophisticated investors from people who just follow the crowd. Let me give you another example that illustrates this principle. South Korea. 70% of Korean stocks trade below book value. Below book value. That means these companies are trading for less than their assets minus their liabilities. You could theoretically buy them, liquidate them, and make money. Why? Because of structural issues with corporate governance. Family-owned conglomerates that historically haven't prioritized shareholder value. Cheap valuations that have persisted for decades. But here's where it gets interesting. South Korean policymakers are now implementing a corporate value up program aimed at boosting stock prices through improving financial disclosure, encouraging stock buybacks and higher dividends. They're fixing the structural problems. They're aligning incentives. They're modernizing corporate governance. And when that happens, when you fix structural issues in an economy with strong fundamentals, valuations adjust rapidly, dramatically. The investors who recognize this now, who position themselves before the transformation becomes obvious, those are the investors who will capture the extraordinary returns. The investors who wait until it's proven, they'll get the ordinary returns. Or worse, they'll buy at the peak right before the next correction. That's the pattern. That's always the pattern. Recognize change early. Position boldly. Wait patiently. Profit substantially. But you have to be willing to endure the discomfort of being early, of being misunderstood, of watching your positions fluctuate while everyone tells you you're wrong. Now let me shift this conversation, because there's something even more fundamental we need to discuss. When I talk about emerging markets, most people think I'm talking about geography, about countries, about regions on a map. But that's not what I'm really talking about at all. I'm talking about transformation. I'm talking about the movement of human civilization from poverty to prosperity, from subsistence to abundance, from limitation to possibility. And that transformation, that fundamental shift in human experience, that's the most powerful wealth, creating force in all of human history. Think about what happens when 1 billion people move from poverty into the middle class. When they go from surviving to thriving. When they go from meeting basic needs to having discretionary income for the first time in their family's history. They don't just buy more food. They buy better food. They don't just need shelter. They want comfort. They don't just survive. They aspire. They dream. They consume. They invest. They build. And every single one of those transitions, every single movement up the economic ladder, creates opportunities for businesses that serve those needs, for investors who recognize what's happening. By 2030, 2/3 of the world's middle class will be in Asia, driving unprecedented consumption growth. 2/3. That's not a trend. That's a transformation. That's a fundamental restructuring of global economic power that will define investment returns for the next generation. But here's what most people miss. They hear those numbers and they think consumer goods companies, retail, brand names, the obvious plays. And yes, there's opportunity there. But that's just the surface. That's the visible part of a much deeper transformation. When populations urbanize, they need housing. But they also need construction materials, furniture, appliances, interior design services, home financing, property management, insurance, renovation services. Every new apartment isn't just one transaction. It's dozens of transactions across multiple industries. When people get their first discretionary income, they don't just buy things. They travel. They eat out. They invest in education. They pursue hobbies. They seek entertainment. They improve their health. Each of those behaviors creates demand across entire sectors of the economy. I knew a man once, sharp investor made his career in traditional value investing, who completely missed the China growth story. He understood the thesis intellectually. He could see the demographics. He could read the economic data. But he couldn't overcome his own biases. Chinese companies don't respect intellectual property, he'd say. The accounting isn't transparent. The government interferes too much. The rule of law is weak. I can't invest where I don't trust the system. And everything he said was true. Partially true, at least. But he was so focused on what was wrong that he couldn't see what was right. He couldn't see that despite all those imperfections, despite all those risks, something extraordinary was happening. Hundreds of millions of people were being lifted out of poverty. An entire economy was being modernized. Opportunities were being created at a scale the world had never seen before. And while he was listing all the reasons to stay away, other investors were making generational wealth. That's the lesson I want you to really absorb. Not that you should ignore risk. Not that you should pretend problems don't exist. But that you should never let your focus on what's wrong blind you to what's right. Because opportunity doesn't present itself in perfect packages. It presents itself in messy, complicated, uncertain situations that require judgment, courage, and vision to navigate. Now let me talk about something specific because I think it will crystallize what I'm trying to convey. Technology infrastructure in emerging markets. This is where some of the most extraordinary opportunities exist right now. India's data center capacity is projected to more than double to 270 MW by 2027, driven by increased digitalization, cloud adoption, and AI workloads. More than double in just a few years. That's not growth. That's explosion. That's transformation happening at a pace that creates exceptional investment returns for those positioned to capture it. But think about what that really means. Data centers aren't just buildings with computers. They're the foundation of the entire digital economy. E-commerce, fintech, digital payments, streaming media, cloud computing, artificial intelligence, machine learning. Every digital service that defines modern life requires data center infrastructure. And in India, with 1.4 billion people rapidly digitizing their lives, the demand for this infrastructure is essentially unlimited. You're building the foundation of a digital economy that will serve the world's largest population. That's not speculation. That's not hope. That's recognizing a fundamental need and understanding that whoever provides the infrastructure to meet that need will capture enormous value. Let me give you another angle on this. Southeast Asia's digital economy is expected to reach $100 trillion in gross merchandise value by 2030. $1 trillion in digital goods and services. In a region where, just 20 years ago, internet penetration was minimal and most people had never made an online transaction. Think about what had to happen to create that $1 trillion economy. Physical infrastructure had to be built. Internet connectivity had to expand. Payment systems had to be developed. Logistics networks had to be established. Regulatory frameworks had to evolve. Digital literacy had to spread. Consumer trust had to be earned. Every single one of those requirements, every single building block of that digital economy represents investment opportunities. Companies building the infrastructure. Companies providing the services. Companies enabling the transactions. Companies solving the problems that arise as economies digitize. And most Western investors, they're not even paying attention. They're focused on the latest AI startup in San Francisco or the newest fintech unicorn in New York, missing entirely the fact that the largest digital transformation in human history is happening in markets they've dismissed as too risky. That's the arbitrage. That's the opportunity. Not in finding something nobody else sees, but in taking seriously what everyone else dismisses. Now, I want to address something that I know is running through your mind. You're thinking, this sounds great in theory. But how do I actually access these opportunities? How do I invest in Indian infrastructure or Southeast Asian e-commerce or Korean corporate reform? And that's a legitimate question, because access matters. Execution matters. It's not enough to recognize opportunity. You have to be able to act on it. The good news is that access has never been easier. Emerging market funds, regional ETFs, ADRs of specific companies, direct access to foreign exchanges for those willing to do the work. The tools exist. The pathways are clear. What's missing isn't access. What's missing is conviction. Most people could invest in emerging markets tomorrow, They could allocate a portion of their portfolio to regions with faster growth, better demographics, stronger fundamentals, cheaper valuations. But they don't. Not because they can't, because they're afraid. And I understand that fear. I truly do. Because emerging markets are volatile. They do experience dramatic swings. They are affected by political uncertainty, currency fluctuations, regulatory changes, all the things that make investors uncomfortable. But here's what you need to understand: that volatility, that uncertainty, that's not a bug. It's a feature. It's the reason for the higher returns. It's the compensation you receive for being willing to tolerate discomfort. If emerging markets felt as safe and stable as U.S. Treasury bonds, they would generate returns like U.S. Treasury bonds. The fact that they're volatile, that they're uncertain, that they make most investors nervous. That's exactly why they offer the potential for exceptional returns. The question isn't whether there's risk. Of course there's risk. The question is whether you're being adequately compensated for that risk. And right now, with emerging markets trading at 35% discounts to developed markets despite having faster growth, better demographics, and stronger fundamentals, I'd argue you're being more than adequately compensated. Let me tell you about another principle that I think is crucial for understanding how to approach these opportunities. Time horizon. Most people invest with entirely the wrong time horizon. They're thinking months or quarters when they should be thinking decades. Since the turn of the century, MSCI emerging market stocks have returned to 6-7% compared to 2-13% for the S&P 500 over 2 decades, not 2 months, not 2 years, 2 decades. And within that period, there were moments, many moments, when emerging markets looked like disasters. The Asian financial crisis, the commodity crash, the taper tantrum, multiple currency crises, political upheavals, pandemics, every reason imaginable to sell, to panic, to run for safety. But over the full period, over the time horizon that actually matters for building wealth, emerging markets outperform, not every year, not every month, but over time, with patience, with persistence. That's the mindset you need, not the mindset of a trader trying to catch every swing, but the mindset of an investor building wealth across decades, recognizing transformation, positioning accordingly, and having the emotional fortitude to stay invested through the inevitable volatility. Now let me talk about something that might surprise you. Africa. Most investors don't even consider Africa. It's not just risky, it's invisible, off the map entirely for serious capital allocation. But Africa has the world's youngest and fastest growing population, with 60% under age 25. The youngest continent, the demographic opposite of Europe, Japan, even China. A massive, young, increasingly educated population entering the workforce, forming families, building businesses. Think about what that means over the next 30 years. While developed countries are aging, struggling with pension crises, dealing with declining workforces, Africa will have a demographic dividend: young workers, growing consumers, expanding economies. And the African Continental Free Trade Area is creating the world's largest free trade area by the number of countries, potentially unlocking 3-4 trillion in economic output, removing trade barriers, creating unified markets, enabling continental scale for businesses that previously could only operate nationally. Is it uncertain? Absolutely. Is the infrastructure insufficient? Without question. Are there political risks? Undeniably. But that's the point. That's exactly the point. The places with the greatest problems are the places with the greatest opportunities. If you have the vision to see past the problems to the potential, I'm not suggesting you bet your retirement on African frontier markets. I'm suggesting you don't dismiss them entirely, that you pay attention, that you learn, that you position yourself to act when specific opportunities meet your criteria. Because the investors who ignore entire continents, who write off entire regions based on headlines and stereotypes, those investors limit their opportunity set so dramatically that they almost guarantee mediocre returns. Let me give you a specific example of what I mean. Mobile money in Africa. Mobile money adoption has revolutionized financial inclusion across Africa, with Kenya's M-Pesa processing more transactions domestically than Western Union handles globally. Think about that for a moment. A mobile payment system in a single African country processes more transactions than the largest remittance company in the world. That's not potential. That's reality. That's innovation happening at scale, creating value, generating returns. And it's happening because Africa leapfrogged traditional banking infrastructure. They didn't need to build bank branches in every village. They went straight to mobile, straight to digital, straight to the technology that actually serves people's needs in a way that's accessible, affordable, and efficient. That's the kind of innovation that creates generational wealth for investors who recognize it early. Not by betting on a specific company necessarily, though that can work, but by understanding that when you solve fundamental problems for massive populations, when you create genuine value at scale, wealth follows. Now let me talk about something that ties all of this together: infrastructure financing. This might sound boring. It might sound technical, but it's one of the most important investment themes of the next 2 decades. India alone plans to invest $1.4 trillion in infrastructure by 2025. Indonesia, Vietnam, Philippines, Thailand, Nigeria, Kenya, dozens of other countries, all investing hundreds of billions in roads, ports, airports, power generation, digital infrastructure, water systems, all the foundational assets that enable economic growth. Where's that money coming from? Governments, yes, but also private investors, pension funds, sovereign wealth funds, infrastructure funds, private equity. Anyone who understands that infrastructure generates stable, long-term cash flows that are essential for retirement portfolios. This is where patient capital makes exceptional returns. Not in 3 months, not in 3 years, but over 30 years. Infrastructure assets that generate predictable revenue from predictable demand, protected by high barriers to entry, essential for economic function. That's the kind of investment that compounds wealth quietly and reliably across decades. While traders are chasing momentum and speculators are betting on the next big thing, infrastructure investors are collecting steady returns from assets that literally enable economic activity. And in emerging markets, where the infrastructure deficit is enormous and the need is urgent, those returns are enhanced by growth. You're not just collecting tolls on existing traffic. The traffic is growing, rapidly, consistently. Because the economies are growing, populations are urbanizing, and commerce is expanding. That's the holy grail of investing: predictable cash flows from essential assets in growing markets. It's not exciting. It doesn't make for interesting cocktail party conversation. But it builds wealth, real wealth, lasting wealth.